Role of monetary policy in debt market. Did you know that bond market is significantly affected by central bank's monetary policy? If not, let me tell you how this happens. But before that, hey, this is Jala, and I welcome you all to our knowledge series by SMEST Discover, where you can get smart about investing. Let's get started. The monetary policy directly affects the bank, as the bank must borrow and lend funds daily to the RBI through repo and reverse repo rates. So, monetary policy is all about adjusting the interest rates. The new rates are passed on to the customers of the bank in the form of loan using a spread mechanism, a process commonly known as monetary policy transmission. The RBI can influence the direction of asset prices through monetary policy. And for this, the central bank may use various monetary policy tools to balance the directional swing in the economy. Let's see how the central bank does it. During recessionary periods, the RBI tends to lower the interest rate to increase money supply in the market. By doing this, the central bank ensures lower cost of borrowing to corporate sector and the banks to foster growth. During the expansionary stage, when the asset prices rise, the central bank may raise the interest rate to reduce the money supply in the market. And by an effective monetary policy, the economic boom and bust cycles can properly be managed. The Monetary Policy Committee is constituted by the central government under Section 45ZB, which determines the policy interest rate. This committee consists of 6 members, including the Governor of RBI as a chairperson, and is assisted by the Monetary Policy Department of RBI in formulating the policy. Now, you might be thinking, what is the actual purpose of the monetary policy? The primary objective of the monetary policy is to maintain price stability while maintaining the required level of growth to support the employment and income of the population at large. The policy framework generally aims at fixing the repo rate based on current and evolving macroeconomic situation in the country as well as global position, liquidity condition, foreign exchange position and many others. The RBI also fixes reverse repo rate as well as the marginal standing facility rates. Too many terminologies to understand and distinguish? These terms correspond to the tools of monetary policy. Let's start with number 1. Repo rate. The RBI lends money to banks in exchange of authorized securities, and interest that RBI charges to the bank is known as repo rate. The aim of repo rate is to help develop interbank money market, which in turn can set benchmarks of pricing loans and deposit. Number 2. Reverse repo rate. RBI borrows funds from bank against approved securities under the liquidity adjustment facility, and the interest rate that bank charges RBI is known as reverse repo rate. Now let's know what does liquidity adjustment facility mean. LAF is a monetary policy tool which is used by the RBI through which it injects or absorbs liquidity into or from the banking system. The LAF helps banks to resolve short-term cash shortages during the period of economic instability. To number 4, which is Marginal Standing Facility or MSF. MSF is a facility for banks to borrow from the RBI in an emergency when they have completely exhausted all borrowing assistance. This borrowing is usually at an interest rate above the repo rate. Number 5, corridor. The central bank maintains and manages the interest rate within a narrow range called interest rate corridor. This corridor is adjusted up and down between the repo rate and reverse repo rate, wherein the reverse repo rate acts as a floor and the repo rate acts as a ceiling. Number 6. Bank rate. The bank rate is the rate of interest which is charged by the RBI while lending loans to a commercial bank. This rate has been aligned to MSF rate and therefore it changes automatically as and when the MSF rate changes. Number 7. Cash reserve ratio or CRR. CRR is a certain percentage of cash that all banks have to keep with the Reserve Bank of India as a deposit. Number 8. Statutory liquidity ratio. Statutory liquidity ratio, or popularly called SLR, is a minimum percent of deposit that the commercial bank maintains through gold, cash, or other securities. These deposits are maintained by the bank themselves and not with the Reserve Bank of India. Number 9. Open market operations or OMOs. OMO is a sale and purchase of government securities and treasury bills by the RBI. The objective of OMO is to regulate the money supply in the economy. When RBI purchases security through OMO, it plans to increase the money supply in the market and support growth, and when RBI sells securities to banks via OMO, it plans to absorb the liquidity from the market to control inflation. Number 10. Market Stabilization Scheme or MSS. MSS is a monetary policy tool introduced in 2004 by RBI to withdraw excess liquidity or money supply by selling government securities in the economy. And the last one, number 11, is long-term repo operations or LTROs. LTRO is a monetary policy tool in which the RBI lends money to the bank for 1 to 3 years at the current repo rate in exchange for government securities. The objective of LTRO is to inject liquidity in the banking system. The overall objective of monetary policy is the management of inflation, unemployment, and maintenance of currency exchange rate. In terms of bond market, the objective of monetary policy is to ensure stable sovereign bond market. In terms of bond market, the objective of monetary policy is to ensure a stable sovereign bond market that would help in establishing a reliable sovereign yield curve. The monetary policy over the years has helped in establishing a well-functioning GSEC market in India and helped the corporate bond market to grow in terms of issuance. That was all for today in this series. We tried to take you a bit deeper in the bond market and its technicalities. Visit SMEST.in and take the next step towards investing wisely. Stay tuned for many more exciting lessons coming your way. But before signing off, always remember, investment in debt securities are subject to market risk. Read all the offer-related documents carefully. For any queries on this module, please leave a comment below. See you in the next video.